Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is May 11th edition of Market Outlook. Don't forget to sign up for this free video and newsletter each week at www.marketgauge.com. Well, quite an interesting week. It looked like yet again a potential disaster in the making, rescued by the markets and some interesting jobs report this Friday. So let's get into it. Well, first thing, um, overall, we're going to step back a little bit and look at some of the longer term trends and channels on some various assets. The first one we're going to cover is the spiders. First thing is you can see that we're definitely trading in this biased up channel. The action and all the moving averages that have people focused on is sort of in the middle of the channel, and we've been going up and down through it, sort of driving everyone pretty much who's a trend follower crazy. If you're a scalper, short term, not so bad, pretty good for the trading. In fact, some of the hedge funds and friends of ours, those that follow the zigzag method and very choppy, are doing quite well, where over the last 5 years they did quite poorly. So everything and everybody goes through cycles. And in this particular case, you can see the yellow line here on the S&P. We held the 100-day moving average, although penetrated the 50 and then back through it. Now, thing to remember is that it seems every time we make some upward progress, we attack the highs, barely make a high or close on a new high by a small margin, and it fails. That could be the pattern up here. We have some evidence that suggests it might be, but again, with this top end of the channel here, you're looking at maybe 215, 216, so maybe another 1 or 2% at best. That's if we clear with some momentum to the upside, and that looks a little bit iffy. Again, long term, you can see on the weekly charts, we're not overbought nor oversold, but what is of interest is that the average directional indicator, which is really an indicator for either trend or choppy markets, is at its lowest level in the last 10 years. I mean, this chart, this particular weekly chart, goes back to 2005. We have not been this low on the ADX, which is an indication of trend, since that period. So very, very much sideways action. It'll be interesting to see what the compression leads. Again, really important support around the 198 level. That is your 65-week moving average, and it also coincides with some support going back to the early part of the year 2015. You can see that, let me zoom in on this, right? You can see important support around this moving average. It coincides, the support from early part of the year in January on that initial sell-off coincides with this very important trend line around the 198 level. So let's keep an eye on that. Bonds, obviously tremendous pressure. Let's take a look at the big channel that's forming. Interesting action here. You can see we topped out early part of the year. Bonds were the hottest thing to be in. That has reversed. In fact, in one of our ETF models, we finally exited after almost being in TLTs for well over a year. We finally exited right around the 128 level. But as you can see, we have now traded under the 200-day moving average convincingly. Try to get through it today on that sort of that jobs report that was sort of mixed quality, and rejected it. Now, looking at the bigger picture here, you can see that this it's trading in this fairly wide channel. Support will come in right around the 117 or 118 level or so. So that's still a bit of a way there. Let's take a look at the weekly as well. So on the weekly, you can see long-term support is at the 65-week moving average. That comes in at around the 119 level. So actual support is just a little bit under that trading support before this market really took off to new highs. So you can see market is trading extremely technically, almost as though some big players are watching it, like even maybe the Federal Reserve, and certainly managing rates in sort of a controlled fashion here. But again, important support comes in around that 119 level or just below. Now, other charts that are of interest on the much longer term picture. Look at this, the top end of this channel that went back to the financial crisis in 2008. Top of that channel, we topped out at the 135 level, 134 level, pretty much coinciding with the top of this channel here. You can even tighten it up and make it based on the wicks. Now, what is interesting is that this trend line here is very, very important long-term support. And it's going to coincide with the very, very long-term monthly moving average as well. This is an 80-month moving average. And again, long-term support comes in at around 120. So depending on your time frame, you can see there are some very, very clear chart patterns across all time frames. And again, long-term support coming in on the monthly, the shorter monthly moving average at around 116. So on a pretty severe panic out of bonds, maybe we can get down to that 116 level. But on the daily charts, you can see support definitely coincides with that level as well. So we've got some intermediate support at that 119 level, and then much more important support on multiple time frames right around 115 to 116 level. So let's keep an eye on that. But that should keep some pressure on the markets. This type of action, this rapidly declining 10-day moving average, penetrating the 200, looks like there will be some more pressure in these markets, and that should mute any major move to the upside in U.S. stocks. Let's talk about volatility. Over here, this is the volatility. This particular chart here is the volatility ratio. When we start getting above 1.2, looking at short-term versus long-term volatility, we turn a bit cautious. It's not a perfect market timing model, but it's pretty good for gauging overbought, oversold within a couple of percentage points in the S&P. So usually you're going to get again a very muted response to the upside as this approaches the 120 level, which it is. So again, today's action up over 250 points definitely has the market in an overbought range. Let's also take a look at the absolute levels of volatility, and you can see even with the sell-off over the last couple days before the massive rally, volatility was pretty low, so there was not much fear in the market as it came off, which was probably an interesting clue in and of itself. Now, we are touching or getting close to the bottom of the channel, and when we get to the lower end of the Bollinger Band at low absolute levels in volatility, we can then consider the market running rich with some irrational exuberance. So again, volatility sentiment definitely running a bit rich here, not totally overbought. You got a little bit more room to the upside, certainly in the VIX. So I could see some more potential action, and then the traditional failure at absolute new highs. Let's take a look at one other thing that is also something to keep track of: IWM. This is IWM with calendar range. This green line here is the high end of the 6-month calendar range. The red line is the 6-month calendar range low. And you can see we attacked and attempted to penetrate this week under the 120 level, which would have been the 6-month, breaking the 6-month high, but it held very strongly at those levels. Now, we do have a broken trend line, so this could be seen as a return move to the trend line. The fact that the IWM is lagging sharply compared to the S&P, one should take note, because this chart pattern has the most significant sideways action before the breakout this year, and now its upside move is in question, with breaking the trend line, trying to penetrate the 6-month, this return move. How it acts here and how far we get through that trend line, if we do, is critical. And on the other hand, if we break down through this 120 level, a good 1.5% to 2% lower from here, that would definitely be a bellwether of a significant down move in the broader indices across the board. Let's take a look at some of the breadth indicators here. McClellan oscillator got oversold. That looks out for the next 2 to 3 weeks or so, and as you can see, the oversold conditions and the inside day that paused in the S&P resulted in that big move to the upside. However, what is interesting is we have not been able to generate from an oversold condition an advanced decline, still running pretty weak here. So interesting that the market is still, from a market internal standpoint, really not doing well. And even with the rally on Friday of substance, we have not been able to penetrate the or trigger a buy signal on advanced declines. So this rally on advanced declines is not broad-based. Up-down volume, not much to read there in the middle of the range, still coming off of an overbought, but by this point in time, this is an indicator of using 10 days worth of data, not really much to see in there. So we usually like to see these things run together, but the fact is that on a longer term basis looking out, this is looking a little bit better. The McClellan, although advanced declines, on a shorter term basis, much weaker. So let's see if we can muster up a bigger head of steam here. So again, more questionable on the internal. So if you add up the information here, bonds looking heavy, the volatility ratio looking a bit overbought, and so sentiment is a bit not that extreme, but somewhat. And so there you have it. Let's take a look at the euro. Interesting. You basically, similar type of action in the bonds. Look at this big channel here. We basically got down, and I had pointed this out several weeks ago, at the bottom of this long-term channel heading from 2008. We basically tested resistance and this important trend line here. It looks like a potential bottom is in place. although it was rejected. The rally was rejected at its at a key moving average and its weekly, longer-term weekly trend line going back to the mid part of 2014. So I could see some pressure, maybe a 50% correction of the move from the lows to the highs, and then a resume. And again, a breakout above this trend line is going to be really key to watch. So weekly charts, put that trend line in on your charts and definitely keep track. This could have a really nice, powerful bounce, at least up to the mid 120s, and resistance at the 65-week moving average. Let's take a look at some commodities of interest. Copper. As you can see, this is slightly different setup, and we're looking at the 20-week moving average. And again, similar type of channel that you saw in FXE. However, this chart is looking a lot stronger than the FXE, which is the euro currency. So commodities, inflation, deflation. Copper is a very, very important and bellwether commodity that foretells inflation. So interesting. The 20-week moving average starting to point up, where we are in this overall downward pointing channel. But again, the fact that for the first time in about a year, the 20-week moving average is pointing up and we're trading well above it. Coincidentally, silver, similar type of channel. You can see from the big move down from mid 2011, this channel worked pretty nicely. And key thing here, we hit the bottom of the channel, did some sideways action, definitely looks basing, and look, right, we're sitting right at that 20-week moving average along with the trend line. So a breakout over the next couple of weeks or next week or so would take out the moving average, trading above the moving average and this pretty important trend line. So that is also an important thing to watch. Copper, silver, and potential inflationary pressures, which makes sense that the bonds are definitely reflecting that, and Yellen projecting that there will be some sort of rate increase in the near future. Let's take a look at a couple of weekly ratios along that line. DBC. This is a weekly chart. These are weekly charts. The first one is DBC, which is a commodity, a broad-based commodity index tracking fund against the S&P 500. Now, one thing to notice, that in just about a year, this is a moving average of the ratio between DBC and SPY. What's interesting is commodities over the last couple weeks, for the first time in about a year, has proven to be outperforming the S&P. So this is a very interesting development and sort of confirms some of the work that we just saw regarding copper and silver as well. Now, there's a lot of oil based in this too, so it's not surprising that we're seeing this basing action, and actually this moving average is not only being penetrated, but it's starting to flatten out and turn up, where it had some really serious downward momentum. All right, I think that covers the markets pretty in depth. You get the overall picture, potential inflationary pressures building up, U.S. stock market, long-term trend still intact, but getting tired with pressure from interest rates that definitely look like it's got more to go to the downside, as well as some interesting developments in the area of market internals and the sentiment indicators as well. Thanks. Bye for now. Hope you enjoyed this. Good luck with your trading. See you next week.